Hello everyone, welcome to the most beginner friendly guide to Indian stock market and options trading. So friends, in this session you will be getting everything, a clear breakdown of everything you need to know before you stepping into the world of options trading. So here in this video we'll be learning what is stock market, what is NSE, BSE, NIFTY, Sensex, then derivatives and options, derivatives, futures, option chain, volume-wise open interest and how it actually works, then some basics of options trading like call put explanations, then expiry, then how to select the strike price. Also, we'll be discussing what is gamma blast and how the support and resistance level actually works in real trades, how weekly and monthly expiry and time decay affect your options, then what is the role of FIIs and DIs and how the global news affects the Indian market. Also guys, we'll be discussing real examples using Nifty, Bank Nifty and stock weightages. So guys, if you are a beginner who's looking for a crystal clear understanding of how trading actually works, then this video is going to help you by building a strong foundation. So let's get started. Hello friends, welcome to another session. So here in this video, we are going to discuss and we'll try to understand the Indian stock market and options trading. So this session, I am going to discuss all the basics which you are supposed to know if you are getting into option trading. So this is mainly for beginners. If you wish to start option trading, I'll be discussing all the basics. Like we'll start with volume, we'll talk about open interest, we'll talk about the strike price, we'll talk about the expiry, we'll talk about in the money, out of the money, at the money options, we'll talk about what are the derivatives, who are the different participants, why and how it is regulated in the market, everything. BSE, NSE, Nifty, Bank Nifty, everything will be covered in this particular video. Okay. So this is again, I'm repeating, those who already have good experience, no need to listen to this. For beginners, this is going to be very useful. So let's start with the session. So what is a stock market? See, stock market is the place where buyers and sellers trade the shares of companies. Okay, so there are trades which are happening at the exchanges and we have NSE and Bombay Stock Exchange. National Stock Exchange and Bombay Stock Exchange are two main exchanges. NSE is the most modern exchange which came in 1990s and BSE came in 1978. Okay, so when we talk about BSE, the associated index is Sensex, and when we talk about NSE, the associated index is Nifty. And you know, Sensex is trading at around 80,000 and Nifty is trading at around 25,000. Okay, so since Sensex started early, it have got a big run up and reached 80,000. Nifty started, as I told you, in 1990s. It have reached 25,000. Now, Nifty is the top 50 companies, whereas Sensex, we talk about the largest, large caps, 30 companies. Bank Nifty will discuss, it has 12 major banking sector including HDFC, ICICI. Okay, so if you see HDFC and ICICI, these two banks itself contribute 50% when it comes to Bank Nifty. In Bank Nifty, the contribution of these two will be 50% and almost 33% these two banks will contribute to Nifty. And if you add Reliance also along with this, which means HDFC, ICICI, Reliance together will contribute 50% in Nifty. Okay, so this is how the weightage and everything. The rest of the weightage we can discuss later. Now, some of you will have the question why Sensex is 80,000 and Nifty is 25k. And as I told you, Nifty started late. Whenever you start an index, normally it starts from 100. Normally it starts from 100 and every year the gains will be added. If you see, inflation is calculated based on WPI or CPI. All these are index numbers which start from 100. This also will start from 100. Like then it keep on adding. And finally, when Sensex started, it was 100. Now it reached at this level. But Nifty when started, it did not start from 100. It started from 1000. Otherwise, what will happen is Sensex have already moved so far. So, it may give a wrong perception among the individual if it starts from 100. that market is falling or something like that. So when Nifty started, it started from 1000, and from there now it reached to 25,000. So this is some basic things which you need to know about Nifty, Sensex, BSE and NSE. See, NSE is the most modern, so more liquid exchange, more participants are there, because here is where most of the market participants were trading. But now in Sensex also you are getting so much of volume, so much of participation is there. Sensex Expiry is also doing good. So we'll be discussing about Sensex Expiry also in this session. I hope this part is very clear. Okay. Now, why these indices are important? Because these indices represent overall market health and offer high liquidity, which is ideal for option trading. When we trade option, we need liquidity. We'll be trading it, trading be it a Sensex or Nifty and Bank Nifty also. That's why when you trade options, you need volatility. This index offer that you need liquidity also. I'll explain what you mean by liquidity, what do you mean by volatility, etc. When we proceed for that. So we'll be seeing clear patterns and cleaner trading patterns when more and more individual participating. So that's how the pattern works. So that's why we are following this index for our trades. Now let's move on to the how the market works. So the price movement is very important. Right? So when we talk about the price movement, it's ultimately based on demand and supply. So the buyers create demand and the sellers create supply. So this is let's say demand curve, and let's say this is supply curve. Okay. So at one point the demand meets the supply. Okay. So this is the equilibrium point, and the price at which the price and y-axis is the price and x-axis is the quantity demanded and supplied. So this is the quantity demanded and supply. So buyers meet sellers at one point, you get the equilibrium price. At this price, this much quantity at this price trade get executed. So buyers meet sellers and sellers meet buyers. So what is that point? Equilibrium point based on demand supply. So now the question is, the price is decided by what? There are a lot of factors. For example, corporate news. Now this is the time of news. So you will be seeing major movements based on the result. So earning result, if it is positive, if the result is positive, it is good for the market. Mergers, acquisitions, all these are affecting the market. Then various economic data like GDP, inflation, interest rates. For example, if GDP is coming good, which is indication that the market is doing really good, economy is good, so it is good for the market. Right. Similarly, if GDP is coming down, then the expectation, that is negative side, that is the bad side. Similarly, if inflation is high, which means the price levels are high. So RBI will try to control inflation. So what RBI will do? RBI will increase the interest rate. So increase in interest rate, this is not good for market. So inflation is not good for market. Interest rate increases also not good for market. So if inflation reduce, then what RBI will do? To promote growth, RBI will reduce the interest rate, which is good for the market. So what we are looking for is low inflation and low interest rate, high GDP. Okay, so this is very important. Apart from that, you have other global events will move the price. For example, Fed decision. Fed again, a decision will be based on interest rate only. So if they also based on US inflation, whatever we discussed here, the same comes here, but related to US. Okay, if inflation is there in US, interest rate will increase, which is not good for their economy and also for us. So I'll tell you how it is working for us. Similarly, if inflation is less, interest will come down, which is good for their economy as well as for the global economy also. So now you need to understand these two terms. There is something called as quantitative easing, and the opposite of that is Fed tapering. So quantitative easing means interest rate will reduce. So what they want to do is they want to increase liquidity. So to increase liquidity, interest rate will reduce. So more money will be pumped in. As a result of it, this money will flow to developing economies. So they can borrow at a lower interest and go to developing economies like China, Taiwan, India. So do we get the benefit? We get the benefit. So FIIs will come heavily. So FIIs will buy, which is good for the market. The opposite is what? Fed tapering. They increase the interest rate. So what they are doing here, they will reduce the liquidity, suck out money. Tight money policy. Then what will happen? These FIIs will take money back because there the interest is high. They will invest there, which is more safer. So which is called as flight of capital. So I hope this much is very clear. So quantitative easing, Fed tapering. Quantitative easing is good for the market, but the opposite is Fed tapering is bad for the market. Okay, so now next, institutional activity. So FII, DII, they have huge funds, and if they are buying means which is good for the market, and if they are selling means it's bad for the market. So we need to keep a track on FII and DII activity. Because they have a huge liquidity and they can move the prices in a big scale. So these are the major things which move the price action. So why FIIs and DII? Because they have huge funds, right? So they can decide in which direction market can move. So if FIIs are pumping money means market will go one side. So if I want to give an example, I've already given this example. If RBI raises the repo rates, what will happen if inflation is there? To control inflation, as I told you, tight money policy. That means interest rate is high. To hike the interest rate, RBI will increase the repo rate. And repo, there is something called as a reverse repo. Then there's something called as SLR. Then something called as CRR. Okay. And then marginal standing facility, everything else is connected with repo. So if repo increase, this also will increase. So this is what called as tight money policy. So tight money policy means interest. If interest is high, will you borrow? So the borrowing will come down. As a result of this, what will happen? The demand in the market will come down because we don't have purchasing power. You borrow from bank, you take loan, you buy. So this will affect the real estate, this will affect the auto sector, every sector will get affected. And most importantly, when people won't borrow, it affects the banks also badly. Why? Because what is the source of income for bank? Source of income is the loans and the interest they get from the loans. Right? So if they cannot give loans or if they won't get interest, then what will happen? Banks' profit will be affected. The profitability will come down. So banking stocks will collapse. RBI is increasing repo, not good for the market. RBI is reducing repo, good for the market, good for the banks, good for us also. So the EMIs will come down. Perfect? Now let's look at what do you mean by futures. So futures are, let's look at derivatives. What do you mean by derivatives? This name itself will tell, right? These are something which are derived from the underlying asset. So there will be some underlying asset. So it could be Nifty, Bank Nifty. So Nifty futures, Nifty options, Bank Nifty futures, Bank Nifty options. So there are underlying assets. So this Nifty means underlying asset is based on 50 companies. Bank Nifty means the underlying asset which is based on 12 banking stocks. So there is an underlying asset from which the derivatives are derived. What are the derivatives? Futures and options. Right? So futures, these are contracts. So you have an obligation to buy or sell that asset at a predetermined price on a specific future date. That means predetermined date or rate. And rate. So here you have a predetermined price rate. Predetermined rate and predetermined date. That predetermined date is what? Your expiry date. Okay, rate, that is what the future you will be seeing the rate. So now when it comes to options, it is also the same. So as an option buyer, you don't have any obligation. That's your right to buy as an option buyer. But as an option seller, you have an obligation. So again, based on predetermined rate and date, that rate is your strike price, right? The rate, the predetermined rate is your strike price and date is your expiry. I hope you got this much. So there's an underlying asset, Bank Nifty. It is based on 12 banking stocks, Nifty, which is based on 50 stocks, the top larger companies. So futures means obligation to buy or sell at a predetermined rate and date. Options, when you are buying, it is a right to buy on a predetermined rate and date. That rate is your strike price, date is your expiry. If you are an option seller, then it will be similar to futures. That becomes obligation. Right become obligation. So when you have a right, the advantage is then you have a choice whether to execute it or not. If you want to execute, you will execute. If you don't want to execute, you are right. You don't want to execute. There is no compulsion. But that's not the case with sellers, option sellers. That's not the case with the future traders. Okay. So that's another point which I wanted to discuss. So now let's understand what is call option and what is put option, right? So see, as I told you, it is basically giving the buyer the right to buy the underlying asset at the strike price. That's what I mean by predetermined rate. And call option increase the value if the market rise. So if the market is going up, what will happen? Call option price will go up. So when you expect the market to go up, you will be buying the call option. Opposite is what? Put option. So when you expect the market to come down, you will be buying put option. So put option will increase the value when the market comes down. Call option will increase the value when the market goes up. Okay, so call option will profit when the market rise above the strike price because you are already paying a premium also. Okay, so here risk is limited. This is a premium. Now, whatever you paid is your risk and profit unlimited profit potential. For example, you are buying 25,000 Nifty call option. So if it is moving to 30,000, it may not happen suddenly. So if it is moving to 30,000, you will have a profit of 5,000. You might have paid a premium of 150. So in case if you're losing, you will be losing this. But hypothetically, in case if you're winning, you may win this 30 times, 40 times, 50 times, 100 times possible. I'm just talking about possibility. So when you know that the market is going up, you are going to buy call option. Okay. If you're assuming that the market is coming down, then you have to buy put option. Opposite is what? Seller's case. So if you're assuming the market is going up, you will be selling put option. If you're assuming that the market is coming down, then you will be selling call option. Okay. Now again, these are again basics. What do you mean by strike price? This is a price at which you can buy or sell. Assume you are this. This is what mean by the predetermined rate and date. So okay, so that's a price at which you can buy or sell. That's a price at which you will be getting the right to buy, or you have the obligation to sell whatever. Okay, now what is a premium? Premium is nothing but the cost of the option. Assume that, as I told you, if you want to buy this, you need to pay this, means this is the premium. So if you are going for out of the money, here I am discussing out of the money means far from the spot. So there will be only time value. The premium, when you calculate the premium, there will be intrinsic value and extrinsic value. In intrinsic value means the real value. Extrinsic value means is the time value. So if you take OTM, there is only time value. If you take ITM, there will be more real value plus some time value. If you take at the money, there will be some real value plus some values, time values is also there. Out of the money, only time value will be there. So out of the money will decay faster. At the money means the one which is close to the spot price. So then what is the spot price? Spot price is the current price of the asset. So let's say Bank Nifty is trading at 51,800. 51,800 is the spot price. Let's say if it is trading at 54,825, this is what the spot price. Okay, so if the market is bullish, when you talk about the futures price, there will be some premium. Okay, now when you talk about the at the money, the one which is close to this, what is that? 54,800, the nearest 100. The one which is close to that spot price, that's the at the money. So, in the money, which is option with the real value, out of the money, there is no real value, far from spot, only time value. Winning out of the money option, the probability is less. Winning in the money option, probability is higher, which is based on delta. And spot price, which is close to spot price, that's what at the money. Okay. So we need to have an idea about this because that's what matters when it comes to, when you decide the market outlook or your risk tolerance. Everywhere it is very important, and trading strategy also. For example, when we are scalping, we may take at the money or we may take slightly in the money. We never go for out of the money for scalping. Okay. Now, we need to understand the expiry part. So, weekly expiry, as of now, we have NIFTY and Sensex. Earlier, we had weekly expiry for NIFTY, Bank Nifty, Mid Cap Nifty, FIIDII, Sensex, BankX we had. So, that was very good time. Now, NIFTY and Sensex. NIFTY have on Thursday, okay? And then we have Bank Nifty expiry on Thursday of month. It's monthly, okay? Then time decay, I've already discussed. Options will lose value as and when the expiry approaches. For example, if you take weekly option, let's take Nifty. So Thursday expiry, Friday there is no much decay. Then what will happen on Monday? Monday decay will be more. And then what happens on Tuesday? Tuesday decay will be even more than Monday. And Wednesday, especially afternoon, decay will be higher and maximum on expiry day. So this is how you need to understand the decay part. Same is the case with monthly. First week of the month, lesser time decay. Second week of the month, slightly more than first week. Third week of the month, more than second week. Fourth week of the month, more than third week. And within the fourth week, again you go with this Friday, Monday, Tuesday, Wednesday, Thursday, last day, maximum decay. Now one more point, if the expiry is on a holiday, let's say normally Thursday is your expiry. So this is a holiday. If this is a holiday, then previous day, Wednesday will be the expiry, just like what happened last week. If Thursday is a holiday, Wednesday is also a holiday, then Tuesday. So it should be shifted to the previous day, not to the next day. It will be closed on the previous day. Okay. Now you have to understand this option chain structure also. That's nothing but display. You will see all the strike prices displayed with the premium, which means the LTP and open interest for calls and puts. Everything will be there. You will get that in your broker's terminal or any tools that you are using. You will be seeing there. Then open interest. That's nothing but the number of outstanding contract on each strike price. Okay, higher the open interest means higher the interest at a particular strike price, and that will act as support or resistance also. Higher open interest will help you to identify support resistance. So, some people have confusion with respect to open interest and volume. Listen, open interest means outstanding contract, existing contract. For example, a contract is created by a seller. So, A is a seller, A sold to B. Now, there is a contract which is created. So, there is one open. Now, if you see here, what is the open interest now? What is the volume now? Open interest is 1. One trade has taken place. So, volume is 1. Now, B is selling the same to C. Now, what will happen? B is out. A sold. Now, with C it is. So, open interest is not changing. The contract, the same contract. But volume, there is one more volume because one more trade has been taken. So, C is selling to D. That means C is out now. It is now with D. So open interest is still 1, but when it comes to volume, it is 3. So as of now, if you look at the market, OI is 1, but volume is 3. Then if you see, D is all back to A. Now the contract is closed. So what will happen? Now the open interest is 0. But if you look at volume, there is one more added. So there is no open interest, but volume is there. That's a difference that you need to understand. So existing contract is the open interest. Okay. So high call open interest is, you see, that is a resistance. High put up open interest is support. So CE higher, where you will identify PE higher, where you will identify. So this will be your resistance and this will be your support. Okay. So higher CE, your resistance, higher PE, your support. So let's say at 25,000, Nifty having huge call option has been sold, or higher open interest is at 25,000. So what does that indicate? 25,000 is a strong resistance. Put open interest is at 24,000. What does that indicate? A put option writing huge OI is at 24,000. What does that indicate? That's a strong support. So maximum participants are there. Now imagine if this level is broken, then what will happen? All these people who sold at 24,000, they will run to cover the position. So they already sold, they will run to cover the position, means huge buying will happen now. That will lead to further down move. That's what gamma blast. Sudden sharp spikes, because their stop loss will be just below that. All these stop losses will be triggered. They all will buy. They all will cover position. Gamma blast will happen. Similarly, on the higher side also, this major resistance is broken. So whoever sold the call option or whoever short the futures, they will all have to cover the position. So huge buying will happen there also. If they sold it, the buying will happen. Right? So that will trigger a fresh rally and fresh breakout again, and that's what I mean by gamma blast. So I hope you understood how higher call open interest act as resistance, higher put option interest act as support, and if the support is broken, huge move will be there on the downside to cover the position. That's what gamma blast. Same on the upside also. Okay, now we'll quickly see who are the market participants. So you see, as I discussed before, you have FIIs, the foreign institutional investors, and then you have DIIs and the retail traders like you, me, etc. So DIIs are domestic institutional investors like various mutual funds, LIC, etc. Okay, and then retail traders like you, me, etc. And then the prop firms, prop desks, and then HFTs, high frequency trading algos, and then all these are the market participants. Apart from that, why we trade index options? It's mainly because, especially Nifty, Bank Nifty, there's a high liquid. So better fills and narrow spreads. So when we trade in options, some option is called, LTP is 245. When you press the market order, we should not get it at 255 or 250. Then upon entry itself, you are losing almost 10 or 5%. So that's not good. We are looking for that profit only. So entry itself we are losing. That's not good. So what we need is a spread of maximum 0.5 paisa to 1 rupee maximum. This will happen only if enough liquidity is there in the market. We need narrow spread, means the bid and ask price. The bid and ask price should have a difference of more than 1 rupee. So let's say the bid price is 245 and ask price should be 246, something like that, maximum. So that's why we are trading something which is having high liquidity. And why are we trading option? Mainly because of that and scalability is also high. You can even trade with 5,000 also. You can trade with 1 crore capital also. Right? And since there's a fixed expiry, huge participants, we have a clear pattern. We can plan easily what we need to do on Monday, Tuesday based on expiry. We can plan. So that's it, guys. That's all what I wanted to discuss in this session. So thank you so much for watching. See you in the next video.